All right, perfect. Well, thank you so much for everybody that's going to be joining. We're going to kick it off right away here at noon, just for everybody's time, especially for taking some time out of work. But as we were putting this together, I was reflecting on a couple of things, and one of them was just how impossible this would have been if we were still at Wells Fargo Advisors, being able to put on a market outlook for you all to provide some insights into what we're thinking looking forward here. And so I just want to say thank you for your trust and confidence for our transition and transition to Petros. We don't take that lightly or for granted, and excited to have a number of announcements here for you today. Before we dive in, the first thing I want to start off with, Bree, if you can go to the next slide. When we're diving into some of the details, this picture really stood out to me as being able to see a beautiful background in nature, and somehow through that beauty, somebody figured out to invent financial derivatives. And so I want to point this out because we're going to be diving into a lot of numbers and data, but really comes down to, are you guys able to achieve the goals that you want to achieve in a comfortable way? And so it's always a good time when the calendar flips over to just reassess and check in with the advisor and your advisor, and making sure that you have the right amount of growth as well as protection to make sure that you're not staying up late at night. And so I thought that was a good picture to start off with. As far as what we're going to do today for our agenda, we're going to have Kate Johnson, our analyst, take a look and put it in perspective as far as where we came from 2024, and then summarize what our outlook is for the whole year before we start diving in a little bit deeper. Kate's going to be joining and talking through the things that we're excited about and looking forward to. And then Tom Carlin is going to be covering some of the things that we're a little nervous about and a little bit more cautious about. And then I'll do a little recap as well as share a couple of announcements for 2025, some initiatives that we're rolling out for this year. And then at the end, we should have some time for some questions. And we have everybody on mute for now, just for efficiency purposes. But if you'd like to ask a question, you can put that or type that in the chat, and I'll be summarizing that throughout the presentation. And so if you had some questions or things you want to dive a little bit deeper on, we'll be aggregating those and maybe knocking out a couple of those towards the end during the summary there. So feel free to message that. And then if we don't get to your questions now, or you have some more specific questions, just link up with your advisor, and happy to follow up with you. So with that all in mind, I'll hand it over to Kate Johnson to start covering 2024 and how that went. Bree, if I double check where Kate's mute there. There we go. All right,
Thanks,
good
Carl,
to go, Kate.
and hello, everyone. I wanted to start by quickly reviewing 2024 and taking a look at just broader returns from the market. The table on the left shows returns by notable asset classes, and the top two are what we pay keen attention to as we utilize those in our benchmarks here at Petros. Those being the MSCI ACWI, which measures global stocks, so US and international combined, which managed roughly a 17% return for the year. And then the Bloomberg US Aggregate Bond Index, which we use as a proxy for fixed income, managed roughly a 1% return for the year. But the far and away best performing asset class listed here was the S&P 500, which many of you are probably familiar with, US large cap stocks, which managed a 25% return on the year. And so in the equity markets, we saw a pretty similar story to 2023, with US large caps continuing to dominate the market. And what's interesting is if you look at that bottom index, the MSCI EAFE, which measures just international stocks with a 4% return for the year, but then you include US stocks in the ACWI for 17%, that just goes to show the attribution and dominance that large cap stocks have shown in the last 2 years and change. But let's drill a little bit deeper into the S&P and look at individual sector returns on the right-hand side there. The best performing sectors in 2024 were communication services, which is heavily driven by Google, Meta, and Netflix with a 34% return, the financial sector, and also consumer discretionary, which is heavily driven by Tesla and Amazon. Some of the worst performing sectors in 2024 were energy, real estate, healthcare, and materials. And some of those were actually or currently are the lowest weighted sectors in the S&P 500. What's interesting here is energy and healthcare were actually some of the best performers in 2022 when interest rates were rising and inflation was high. So I think that's a testament that just goes to show how quickly market conditions can change as well as sentiment from year to year. So those were the returns for 2024, but what was the street predicting for markets last year? So let's rewind back to January 1st of 2024 with the S&P starting that year at around 4,700 as an index level on the right-hand side there. But this table shows each Wall Street firm's year-end target for the S&P. And while the majority of institutions picked the index to be higher, it was a little bit of a mixed bag. And so with the S&P ending the year at over 5,800, that blew any predictions clearly out of the water. So this is a good example that goes to show just how difficult it can be to predict where markets will be a year from now, just in how volatile they can be. But what are those same firms thinking for 2025? If we take those same institutions, their predictions for 2025 are much, much more optimistic. So the S&P 500 this year started at around 5880 as an index level on the right-hand side. You can see here that every bank listed is bullish and expects the S&P to be higher by year end. Again, it can be nearly impossible to predict where markets will be by the end of the year, but we can use this at least as a useful gauge as to what the street is thinking and provides us a framework as to how we see the year playing out. And so with that being said, our outlook for 2025 is positive for the first half for equities and a little bit less favorable in the second half. We see some strong economic tailwinds remaining prevalent as we head into new White House administration. And we also see animal spirits coming into play, which essentially just means investors, especially the younger population, are becoming more prominent and having higher appetites for risk. And when markets do well for longer periods of time, consumers and people alike naturally want to be more involved in order to avoid getting FOMO or the fear of missing out. So we found 3 areas of the market that we like particularly more than others, or what we call overweights. Those being small cap stocks, financials, and the industrial sector. And I'll touch on those in a little bit. But first, let's go and talk about the good news that supports our case for a strong first half of 2025. So the first driving factor is going to be the continued interest rate cutting cycle. Now, the Federal Reserve, they set the target for short-term interest rates, or also called the federal funds rate. Current Fed funds rate is in the range of 4.25% to 4.5%. But what's interesting here is where the Fed thinks interest rates will end up a year from now, or at the end of 2025. This table on the right-hand side was taken from the most recent Fed meeting back in December when they cut interest rates another 0.25%. And in the red circle on the left-hand side, the top number, 3.9%, is now where they think the Fed funds rate will end up at the end of 2025. But when they met in September of 2024, they thought rates would actually be lower at the end of 25, hovering around 3.4% in that bottom number. So they're kind of jumping all over the place now. That still implies approximately 2 more rate cuts for this year. Keep in mind, I think we should take the Fed's short-term view with a grain of salt because not too long ago, they thought inflation was transitory, and then all of a sudden it went up to 9%. So what we should really conclude from this is that the Fed's long-term goals haven't really changed at all. Their long-term target rate, or what they call the neutral policy rate, that would be ideal in perpetuity, is in the range of about 3%, shown in that red circle on the right-hand side. And that hasn't really changed at all between the September and December Fed meetings. So while one can argue that the shorter term outlook for rates has gotten less favorable, nothing has really changed in the longer term outlook, which is key. And all that means is the rate cutting window is just now being extended and the Fed is still long term dovish. So we see that as a positive catalyst for the markets. But why does this matter at all? Does this impact the markets? Well, the answer is yes. And how do markets actually perform in the midst of these rate cutting cycles? This chart's a really good visual of those scenarios and shows the S&P performance since 1980 in blue and the times when the Fed has cut rates near all-time highs, and those are the green dots along the way. So it's happened 20 times since 1980 that the Federal Reserve has cut interest rates within 2% of all-time highs for the S&P. And all 20 of those times, the S&P was higher a year later with a median return of about 10%. And the good news is, like I mentioned earlier, the Fed cut rates again in December, and the S&P was within 2% of all-time highs heading into that day. So we're supportive of this trend continuing and markets likely being higher by next December. Another sign of good news is still the amount of wealth in cash or money market. This chart shows the assets in those money market funds since the year 2000. And you can see we're at all-time highs, hovering around 6.8, almost 7 trillion still on the sidelines. And when you combine this with rate cuts, we could see cash no longer being a formidable investment strategy because that 4.5%, 5% that you were collecting a year ago is now projected to be below 4% by year end. And so a good portion of this capital could be either deployed to stocks or bonds, likely going to be a mix of both. But even if the market takes a 10 to 15% dip, we could see a lot of this dry powder coming out of the sidelines and swooping into the equity markets, buying that dip and riding it higher. So this continues to support our animal spirits thesis of investors, especially younger investors, wanting to get more involved in taking equity risk. The last piece of good news that I'll show you is this really interesting chart showing all the bull markets in history since the 1970s, approximately. And on average, each bull market listed here has lasted at least 5 years. And you can see the current bull market that we're in is in the bottom left-hand side, and that red line started in October of 2022. So it recently hit over the 2-year mark. You can see that red arrow pointing downward to where we're at today. You know, around that 2-year mark, there seems to be a little bit of choppiness or flattening out for most bull markets in history before riding higher. So we think this could be indicative of maybe a less favorable second half to the year. But overall, our view is still fairly positive looking at this. So with all the good news covered, that leads us into areas of the market that we like particularly more than others, or what we call overweights. The first I want to highlight is small cap stocks. Small caps are historically very undervalued relative to large cap stocks, specifically the S&P. And in fact, they're at their most attractive levels since the year 1999, 2000. Another reason we like small caps is because IPO and mergers and acquisitions activity could pick up due to lower cost of capital, a more business-friendly FTC, and overall easier access to external financing to support that business growth. And lastly, broader market participation can be healthy, right? Large cap stocks in the S&P, especially technology names, have dominated the headlines for the last 2 years or so. And we could see other areas of the market, other asset classes, start to pick up or catch up, so to speak, which would be more sustainable for the long term and lessen that concentration at the top of the market. This is a chart that speaks to the huge valuation disparity between those small and large caps. When this black line dips lower, that's a signal that small caps are becoming relatively attractive. And that red circle goes back to the year 1999, 2000, like I mentioned. And if you follow that red line to the right over to today, you can see that we're at those similar levels, even more attractive levels than we were back then. But what happened to small cap stocks in 2000? How did they perform? So this chart's showing just the performance of the Russell 2000 small cap stocks versus the S&P 500 large cap stocks. Small caps are in purple there, starting in 2000, and over the next decade plus till 2011, they outperformed large caps by about 65%, even including the 2008 recession. And so while we don't think we're in a 2000 type scenario, these valuations do at least paint a picture that there could be opportunity for small caps to outperform well in the near future. Our second overweight is going to be the financial sector. New White House administration is likely to push for deregulation, especially with a new Fed chair to lead the SEC, which bodes well for banks and financials to be big beneficiaries. Mergers and acquisitions activity could also pick up, as I alluded to earlier, which benefits the sector as a whole and primarily the investment banking industry. And lastly, a steeper yield curve is positive for financial institutions, right? As short-term rates continue to fall, banks can now borrow money at those lower short-term rates and lend out at those higher long-term rates. And bank deposits that are paying interest on those short-term rates will also start to roll over and help to improve net interest margins potentially for banks as well. So this is another little valuation piece of showing the financial sector price ratios versus the S&P. And that red circle is where we are today. Trace that red line to the left, and that goes back to the COVID period back in 2020. You can see that today we're at basically similar levels to where we were during COVID. And that can't be said the same for other sectors like technology, consumer discretionary, and industrials that have all had huge rebounds since then. So while the financial sector had a great 2024, this could be indicative of the sector still having more room to run going forward. Our last overweight is going to be the industrial sector. We see the shift to onshore manufacturing being a key trend for businesses looking to reduce international and geopolitical risk. The effects of the COVID-related shutdowns on international trade created some severe disruptions on global supply chains. And so when you combine that with current rising geopolitical tensions across the world, we can see increased motivations for firms to start moving core manufacturing operations back to the US. Fiscal policy implementation also, such as the Inflation Reduction Act and the CHIPS Act, also continue to encourage those companies to reconsider domestic production of those goods and services. A key measure of manufacturing activity is the Purchasing Managers Index, or PMIs, which measures directional economic trends for the sector. The index has been at depressed levels for over a year and a half now, partially due to rate hikes and partially due to fallout from COVID, with companies having supply shortages and then all of a sudden overspending on inventory. And so we expect those trends to continue finding a normalization pattern, especially in a lower interest rate environment. And lastly, industrial companies are also heavily engaged in AI trends. While not at the forefront like the NVIDIAs, Teslas, Googles, Metas of the world, many industrial companies are behind the scenes, either helping to support that technological infrastructure or finding ways to enhance their own business practices through automation. So this is a chart of that PMI that I mentioned, and the purple is showing the performance of it since 1990. The dashed black line is the baseline and it's set at 50. And so when the index drops below 50, that's a signal of a trend of declining manufacturing activity. But when it dips below 50, bottoms, and then starts to recover upward again, we tend to see good returns for the industrial sector on average. And so currently we're in a similar position. That red line going across represents a level of 47. And specifically, when the PMI drops below 47 over the next 12 months, industrial stocks are up 95% of the time with an average return of 22% over the next 12 months on average since the year 1990. And so the PMI did drop below 47 back in October of 2024. So we're supportive of industrial stocks being higher, at least for the first half of 2025. So that's our thesis on the good news that supports our good half to the first year of 2025 and our market overweights. So now I'll pass it to my colleague Tom to go over some of the warning signs that the market is showing.
Thanks, Cade. Notice how the young guys get all the optimistic slides and the old guy gets the pessimistic slides here. So I've been through a few corrections. So we are, as of today, on the 30-year Treasury. It is rising again to 4.96% early in the day because unemployment numbers did not be registered as high as they thought. Interesting fact that the 30-year Treasury now is at an 18-year high. So I know that once you get taken off mute, a few of you will love to say some things about the Treasury being at an 18-year high at not even 5%. But think about that. People like Cade and Carl, this is almost the highest interest rates they've seen since being in the stock market. So a word of caution on valuations, how higher interest rates could affect valuations. And the slide here, really, if you look at the right, shows that on the growth side of the small box on the right-hand side there, shows the large cap valuations now are trading close to 30, when historic valuations are around 19. That box spread is by far and away the largest indicator of possibly overvaluations. And if you look where maybe the valuations are normal or undervalued, nothing really is technically undervalued, but more to historical valuations, the small cap value box where it's highlighted in red is a 17.2 PE, and the normal valuations is about 16.8. The other two areas that are probably more close to equal weight are both the mid value and mid blend. Clearly, if you've avoided these three boxes, you've done really well if you've been oversaturated in large cap growth, which most people have. But now, again, some of the warning signs with interest rates starting to get back, there are choices for your money to actually earn safe investments. So good time to possibly look at that and reallocate to other areas in the market. And our next slide, on slide 20, we see the PEs after the PEs that we've had. What type of PE or what type of outlooks or returns do we get with historical higher PEs? This line is a 1 year on the left that shows kind of a little bit more negative returns on a 1 year basis. But as you look on the box to the right and you look out even 5 years down the road, the line in terms of real rate of returns is a lot closer to flat. And as we go to the next slide, some cautionary things to think about is on the Doge effectiveness. And for those of you who are asking what is Doge, that's the Department of Government Efficiency, which Elon Musk is possibly taking a look to be in charge of. And they're talking about reducing the spending in the government spending on the federal side. And stats have said that if government spending goes down by 5%, you could see a reduction in the GDP by 1% across the board. this could significantly slow down growth. And again, cautionary signs of if growth slows, most like returns in the stock market could be something to watch about. But that's the pessimistic news. Carl, if you want to recap from here.
Yeah, for sure. So yeah, just as a summary, we do think generally positive for equities, but like Tom is going over and then Cade went over as far as the length of these bull markets, starting to see a little bit of some signs that we might want to be a little bit more cautious here as we get into the second half. We're going to be doing a mid-year outlook as well for everybody. So we'll let you know some of the data changes or some of our assessment changes, and shoot for that June timeframe for you. And then just as a reminder, if you wanted to add a question, you can certainly add that to that little chat. There's usually a little toolbar, and it's a little icon. You can click chat and type in a question. And so if there are questions, we're happy to answer them. But while you're typing in that, let's go to the next slide, and then I'll kind of preview some of the initiatives we've been working on that we're finally able to roll out for you. So a couple things as we head into 2025. We just completed our transition or creation of an advanced performance reporting tool called Black Diamond. And we've been beta testing with a few folks and working out the kinks. And we'll probably roll it out in the spring. But if you wanted to kind of take a look and see, really kind of nerd out on the performance and see how you're allocated and where your areas of weakness are or opportunities are, go ahead and email Cade, Cade at petrosfw.com, and it gets you set up. That one does have an app to it, and for many folks that were also set up on our eMoney, our planning website, there's a nice link where it actually you can talk back and forth essentially, or toggle back and forth between our planning website, eMoney, and then this Black Diamond performance reporting. So that's our first news. The second one is as many of you know, your assets are held with First Clearing, which Wells Fargo owns, and it's finally coming to fruition where there's actually going to be integration into the Wells Fargo app. So if you have a Wells Fargo bank account or mortgage or accounts, in that May-July timeframe is when we were promised that you'll also be able to see your accounts with us or Petros all on that one spot, similar to what we had when we were fully with Wells Fargo Advisors. Another initiatives, just like Cade was mentioning with the interest rates coming down, there's been a lot of really great high yield savings accounts out there. One that we partner with a company called Flourish, what they do is pretty neat. We don't get paid on it or anything. It's just an added service for you all if you wanted it, but it is invite only. And what they do is whatever money that you want to park with them in a savings account, they actually shop it with all the other banks. So you can get up to like $2 million of FDIC insured savings, and I think they are in the 4% interest rate right now. And so that'll go down every time the Federal Reserve lowers rates as well. But it's a great high yield savings for any vacation funds or extra cash. And there's no limitations, limitations on money movement. You can move a penny, you can move $1 million, whatever you want there. And so if you wanted to test that out for us, we have a number of clients set up on there. Just email Brianna at petrosfw.com. And then second to last one is through Trust and Will. That's an online service, very low cost. Wills, trust, and estate, generally better for kind of the basic documents. For married couples, even the trust work is usually in that $500 range. So it's very, very inexpensive and very easy to use. And so anybody that's New Year's resolution to get their estate planning done, just shoot me an email, Carl at petrosfw.com, and we can get you set up a timeline to meet and talk through what you might want on the estate, and then get you set up through Trust and Will there to actually create it. Last one is we are beta testing our tax preparation service, and we should have it fully operational for everyone for the tax year 2025. And so if you are interested in having a tax preparer kind of integrated with us, those are the costs there. And what we're trying to do is reframe the mindset on the tax preparation is not just the nugging of the numbers, but also trying to proactively find opportunities to make you money or save you money. And so part of that preparation is we're doing an actual tax planning meeting in the fall, winter, to try to find make sure there's opportunities for saving money or making sure there's no surprises there. We can actually project intra-year. So yeah, so those are the main pieces there, and I don't see any questions in the chat.